In this video, I will explain a simple swing trading strategy, which is also a trend following strategy. I have a small request, friends. Before commenting your questions or doubts or any feedback, I request you to watch the video till the end, because many times people watch only 5 minutes or maximum 10 minutes of the content and they will come up with the questions or their feedback. So in most of the cases, 90% of the cases, their questions or feedback would have answered if they watch the video till the end. So I request you to watch the video till the end before asking any doubts or questions. So I will be explaining a simple swing trading strategy, which is also a trend following strategy, in detail. Now, before I explain, you need to understand what is swing trading, because many people idea or definition of swing trading is different. So basically we have three important types of trading. One is intraday. Intraday means we will buy today, we will sell today itself. So another one is swing trading. In swing trading, we will buy today and we will hold maximum for the duration of 1 month. So from 1 day to 1 month, the holding period comes under swing trading. Sometimes we also do BTST and STBT trading, which means we will buy today, sell tomorrow, which means probably they would have planned for swing trading, but they got the majority move within 1 day or 2 days, so they will make an exit. So BTST trading is also there, but predominantly we have intraday trading, swing trading and positional trading. Any trades with a holding period of more than 1 month comes under positional trading. Very simple. Intraday trading, we will buy today, we will close it, sell today itself. Swing trading, we will buy today, hold for the duration of maximum 1 month, that comes under swing trading. And any trades which in which holding period is more than 1 month comes under positional trading. I hope now this is clear. Now, under swing trading, people follow many aspects of technical analysis for swing trading. So some of them are trend following, some of them are price action, some of them are based on support resistance, some of them are based on indicators, some of them based on trend reversal also, some of them based on moving average. Moving average is the popular indicator which is used for swing trading. Now, as part of this video, I'll be explaining a strategy which comes under the trend following. Okay, so this is very, very important. Now, what is trend following? Probably you might know it, but many people don't know what is the idea of trend following. See, taking a trade in the direction of the trend comes under the trend following strategy. See, for example, price is in an uptrend, right? In this case, the price is in an uptrend. So taking a long trade, because this comes under the direction of the trend, original trend, right? So this can be recognized as trend following. I hope this is very clear. Now, what is trend reversal? Taking a trade in the opposite direction of the trend to make more profits from each trade can be recognized as trend reversal. Okay, so in this, this trend reversal strategy aims to profit from a change in the direction of a market trend. Okay, traders who employ this technique look for a signs that a current trend is weakening or reaching its such a reversal pattern in price action. Okay, so this is trend reversal. Now, for example, let's say the price is in an uptrend. So this is very clear, it is in an uptrend. So taking a short trade here, anticipating the price will go down, can be recognized as trend reversal. Now this is clear. Trend following is clear, trend reversal is clear. Now people will ask, which is better? Trend following is better, trend reversal is better? See, this is a $1 million question. But the answer is, it depends upon the individual and his mindset. For example, there are you will find many trend following traders. One of them is Sid Saikota. He says the trend is your friend until the end. Okay, and you don't find many trend reversal traders, popular traders in the market, but Paul Tudor Jones is one among them. He says, I believe the very best money is made at the market turns. Everyone says you get killed trying to pick the tops and bottoms, and you make all your money by placing the trend in the middle. Well, for 12 years, I have been missing the meat in the middle, but I have made a lot of money at the tops and bottoms. So, after looking at the Paul Tudor Jones quote, it uh, we think that trend reversal trading is very interesting, and we can make more profits in trend reversal. But Paul Tudor Jones also says one thing in Market Wizard book. Many people say Paul Tudor Jones catch the tops and bottoms successfully, but he insists to add one word. He says Paul Tudor Jones successfully catch the tops and bottoms in his 8th or 9th attempt. I will repeat once again, friends. He says Paul Tudor Jones is able to catch the tops and bottoms in his 8th or 9th attempt, which means he would have tried many number of times and he would have faced more number of failures before he get the huge success. We need to understand whether this concept is applicable and you will be able to apply this concept or not. Why? Because let's say if Paul Tudor Jones had 10 lakh rupees, he will not risk or invest all the 10 lakh rupees in one trade. He will test the waters. For example, he will deploy only 25,000 or 50,000 or maximum 1 lakh in first trade, and he will see whether he is right in catching the reversal or not. So he will deploy all the money once he gets the solid confirmation. So as a retail traders, for us, we may not be able to carry with such a momentum. Digesting failures is very very difficult for us, right? Whether we lose 1000 rupees, 500 rupees, it doesn't matter. So digesting failures will is very difficult for us, and whenever you face 7 8 defeats in one stretch, most people lose their capital because they will be risking more. So I would suggest trend following strategy is suitable for all the normal traders or retail traders like us, and we will leave the trend reverse strategy for the experts like Paul Tudor Jones. So because of this reason, I'm explaining a simple swing trading strategy under the trend following concept. Okay, I hope this is very clear. Now we will discuss the strategy. This strategy is based on RSI indicator, relative strength index indicator. Basically, the traditional definition of RSI is based on two things: overbought and oversold scenario. Whenever the RSI reach 70, they say it is overbought and they look for short trade. Similarly, whenever the RSI is 30, they say it is oversold and they look for a long trade. But right now, as part of this video, this strategy, I will not be using this. I will be focusing on divergence. Okay, RSI divergence. Basically, what divergence says is price makes higher highs, price makes higher highs, higher lows, whereas RSI makes lower high, higher lower lows. So this is divergence. Price is going upside, RSI is going downside. So in this case, it is they recognize as the traditional definition is it is bearish divergence, and it suggests to take a short trade because it says the RSI is going in the opposite direction, right? So they recognize it as bearish divergence and they suggest us to take a short trade in this case. But I don't recommend this because this is not a good idea, because it comes with a lot of risk. For example, if you look at this chart, Nifty, price is continuously making higher highs, higher lows, higher highs, higher lows, which means price is in a strong uptrend. Whereas RSI made lower highs, lower highs, lower lows, lower highs, lower lows, which means we got many number of times we got the bearish divergence, right? So because of this bearish divergence, if you would have taken a short trade, you would have lose money, right? You would have lost money. This is one more example. This is a Titan chart. Once again, the price is in a strong uptrend, right? It made higher lows, higher highs, higher lows, higher highs, whereas RSI made lower lows, lower highs, lower low, lower highs. So many times it made bearish divergence. If you would have taken a short trade, you would have lost money most number of the times or almost all the times, right? This is RSI, divergence in the opposite side, bullish divergence. For example, the price is in a downtrend, which makes it means the price is making lower highs, lower lows, lower highs, lower lows, and the RSI is making higher high, higher low, higher high, higher low, which means it is RSI divergence. In fact, bullish divergence in particular, and it suggests us to take a long trade in this case. But once again, this is not a good idea. For example, if you look at this particular chart, Titan company, price has made lower lows, lower highs, lower lows, lower highs, whereas RSI made higher low, higher high, higher low, higher high. If you would have taken a long trade, you would have lost money almost all the times, right? Why this happens? The simple reason is you will be taking trades in the opposite direction of the trend, isn't it? Because it comes under a contra trading strategy, trend reversal strategy. So, whenever you follow the RSI bullish divergence or RSI bearish divergence as it is, you will be taking a trade in the opposite direction of the trend. That's why it comes with risk. For example, if you go to in this, for example, in bullish divergence, see, when it says it bearish divergence, if you take a short trade here, you will be taking a trade in the opposite direction of the trend, right? The original trend is in the upside direction. You will be taking a trade in the opposite direction, which is not at all a good idea for retail traders. Similarly, when you are taking a see here also, when you're taking a short trade based on this RSI bearish divergence, you are taking a trade in the against opposite direction of the original trend, right? So it is not a good idea to use RSI bullish divergence or RSI bearish divergence as it is. Okay, so this is the important risk involved in this particular concept actually. Now, then what we should do? So I would suggest we should use RSI hidden divergences instead of plain divergences. So hidden divergence is a little tricky compared to the divergence, so, but it's very simple. Whenever the price makes higher highs and higher low, if the RSI makes a lower high, price making an higher low, RSI making an lower high, so this comes under RSI hidden divergence. In fact, it is particularly it's called as RSI bullish divergence. So we can take a long trade. I will explain with a first chart first and then concept first. For example, this is price, right? Price is in a strong uptrend, whereas RSI is making a lower high. In this case, see, for example, price made an higher low, right? This is an higher low, whereas RSI made an lower high, right? So this is called as RSI hidden bullish divergence. So you can use the RSI hidden bullish divergence to take a long trade. I will take a chart particularly for example. So HDFC Life Insurance, the original trend is upside. If you see this from here to here, price made an higher high, right? Price made an higher high, whereas RSI made a lower high, isn't it? I mean lower low actually. Price made an higher low. Price made an higher low, whereas RSI made an lower low, isn't it? So this is a particular good concept for RSI hidden divergence. So this should be low actually. This is a swing low, this is a swing high. So if you get confused, wait, keep it for low actually. So in RSI hidden divergence, always look for low. Because it's very easy to implement and execute. You can also look at the high, but if you look at the low, it is very simple. So price making an higher low, whereas RSI making an lower low. So this is RSI hidden bullish divergence. So one can plan a long trade in this case. I will take one more example. For example, this is also this is not a small company, friends. This is a big company, Bajaj Finserv. So in this case, price made an higher low, price made an higher low, whereas RSI made a lower low, isn't it? So this is also RSI hidden bullish divergence. One can plan a long trade here. Okay, and you can see what happened to the result, right? Price continued its upward direction, and it would have given a very good profit. Now one more example, Bajaj Auto Limited. See, in this case also price made an higher low, whereas RSI made a lower low, isn't it? Price made an higher low, RSI made a lower low. So this is also hidden bullish divergence, and you can see what happened on the next side, right? Price went upside. So I'll be focusing more on hidden bullish divergence because this is as part of a swing trading, trend following swing trading strategy. In swing trading, the holding period comes between 1 day to 1 month. So in India, at the time of recording this video, we can't carry a short position in equity for more than 1 day, right? So because of that reason, I will be focusing more on bullish divergence, hidden bullish divergences, because in equity we can carry long trade for more than 1 month also. There is no problem. So if you follow, let's say if you have taken a trade here, easily you can make profit with a holding period of 1 month, right? So I'll be focusing entry, stop loss, exit after few slides because I'm also explaining everything. So now one more example. For example, this is Hero Motor Corp. Now let's say the price is in price has made a higher low, right? RSI made a lower low. Now tell me, will you take a long trade here? Think for a moment. Okay, so many traders, after listening to this explanation, they will take a trade in this case because according to them, it is RSI hidden bullish divergence because the price has made an higher low, whereas RSI made a lower low. It is perfect hidden bullish divergence, and they will take a long trade. But I suggest you not to take a long trade at this point of time, friends, because you need to understand one thing, how the price and indicator is connected. See friends, indicator, in fact RSI, any indicator are derived from the price. Whenever the price changes, it will push the changes into the RSI indicator and not vice versa. Just because RSI has received hidden bullish divergence, that doesn't mean that RSI will push the price to go upside. It's not like that, friends, because many people, I've seen many comments, many traders making a comment like this: RSI reached this level, now price has to go up. No, it doesn't work like that, friends. Uh, Most of the indicators are derived from the price. So even though it is an RSI hidden bullish divergence in this case, you need to wait for a price confirmation to go upside. So as of now, this confirmation is missing in this case, isn't it? Think again. See, you need to wait for a bullish confirmation, then only you can plan to take a long trade. So in this case, it came down, it might have taken your stop loss and went upside. That's a different story. Losses and profits will be there in every trade, but you need to wait for a bullish confirmation to take a long trade. See, this bullish confirmation comes through with a different pattern, different candlestick pattern. I would suggest these are the four powerful candlestick patterns which can be used as a bullish confirmation in case of RSI hidden bullish divergence before taking a long trade. Okay, first one is bullish Marubozu. In Marubozu, we don't have wicks actually. Now this open low is the open, close high is the close actually. So this is bullish Marubozu. So you have to wait for either bullish Marubozu or bullish engulfing. Bullish engulfing look like this. So first is a bearish candle, then is a bullish candle, which engulfs which means which overlaps the first candle completely. So third one is a big bullish pin bar like this, or bullish harami. It looks like this. It is opposite to bullish engulfing. Now Before taking a long trade, you need to wait until you get any one of these four candlestick pattern, friends. Okay, so this is very, very important because most of the indicators are derived from the price. So even when you are using indicator, you need to wait for the confirmation from the price before taking a trade, in this case a long trade. I hope this is very clear, friends. See, in this case we got a small bullish harami and couple of bullish pin bars. That's why we can take a trade, right? See, again it is a proper RSI hidden divergence, higher low, lower low, right? See, this is one more example. Reliance Industries price has made higher low, RSI made lower low, but you can see this is a bullish harami pattern, right? This is a bullish harami pattern. Now this is one more example, friends. TCS price has made an higher low, very clear. Trend is upside, very strong uptrend. Price has made an higher low. See, RSI made a lower low, but in this case also you can see it made bullish harami pattern, right? Is it clear? So we need to wait for a confirmation from the price to take a long trade before taking a long trade. So now the question is, where do we take the entry, where do we take the stop loss? See, friends, our entry should always come above the bullish candle, bullish confirmation candle, in this case bullish harami, right? So our entry should come above the high of the bullish harami candle, in this case it should come above, like in this candle, and our stop loss should be below the low of the bullish confirmation candle. I've seen many traders, they will take a trade according to this rule, but when it comes to stop loss, either they don't keep the stop loss or they keep pushing the stop loss on the downside. It is not at all a good idea, friends, because anything can happen in the market at any point of time. So based on some strategy, some analysis, you might have taken a trade in this case, but tomorrow anything can happen in the market and price might correct, price might reverse. So you should have a fixed stop loss point in which it indicates your trade analysis has gone wrong, right? So in this case, whenever the price comes below this level, it confirms something is wrong with the strategy. So you should always place a stop loss below the low of the bullish confirmation candle, and entry should always come above the high of the bullish confirmation candle. I hope this is very clear, entry and stop loss. Now exit. See, exit is always a tricky, and nobody can come up with a proper exit or right exit, because nobody can exit at the top, right? It's almost impossible. So based on your mindset and personality, you should come up with your own exit technique. So I would suggest you can opt for 1 is to risk reward. For example, if the risk is 10 points, you can place a reward of 20 points and you can exit when the price reaches 20 points on the upside. So this is one exit technique. Or you can start trailing the stop loss below the low of every swing, because you never know where the price will go. It might go 20 points, it might go 50 points, it might go 100 points, it might go 200 points as well. So some traders have the mindset to trial their stop losses. So such kind of traders can trial their stop losses below the low of everything. This is one thing. And I would suggest for many traders, because I am one of them. I'm not very comfortable to exit at 1 is to 2 risk reward. At the same time, I also not comfortable to trial the stop loss below the low of every swing low. So in those cases, they can take a balanced approach. So what they can do is they can exit their 50% or 75% of the position at 1 is to 2 risk reward. Exit 50% or 75% of the position at 1 is to 2 risk reward, and carry the remaining portion below the low of the every swing. So in this case, if the price comes back after 1:2 risk reward, you don't make any regret because you will be making a profit for 50% of the position. But if the price keeps on going continuously upside, you would have made profit for the 50% of the position, right? So in this way, you can take a balanced approach. One more thing important I wanted to mention is whenever you close 50% of the position for 1:2 risk reward, you can trial the stop loss of remaining 50% position from original stop loss to the entry price. So in this case, even if the price comes back, hits your stop loss, you would have made profit for the 50% of the position, and the remaining 50% of the position will be break even, right? I hope this is very clear. So now I will also explain bearish hidden divergence. It may not be applicable for most of the retail traders because anyway you will not be taking a trade in equity because it's not possible to hold an equity short trade for more than 1 or 2 days in Indian markets. But anyway, I will explain it this. See, price makes lower low, lower high, whereas RSI makes higher low, higher high. This is bearish hidden divergence. Okay, it comes like this: price made an lower high, RSI made an higher high. This is an bearish hidden divergence actually. Now, money management rules, friends, this is very, very important. Many people think the strategy will make the money or profits for them, but definitely, there is no doubt strategy is very important, friends. But along with the strategy, money management rules and trading psychology is also very, very important, friends. See, I would suggest don't invest more than 10% of your capital per trade because this is a swing trade. You cannot calculate the 1 point or 1% or 2% risk rate because tomorrow it might see gap down open and you might lose more than 1% also. So because of that reason, I would suggest invest only 10% of the capital per trade, which means if you have 1 lakh rupees in your as your trading capital, invest 10,000 per trade, which means if the entry price is at 1,000 rupees, you should buy only 10 stocks, right? That means you will be investing 10,000 rupees. If the price comes back and hits your stop loss, in this case, in most of the times you lose only 0.5%, 0.7%, or maximum 1% of your capital per trade. Okay, so I would suggest the number one rule is don't invest more than 10% per trade. Okay, you should invest only 10% per trade, whatever the trade the structure may be. You might think the trade is super duper, but still you should invest only 10% of the capital for that particular trade. Number second rule is don't deploy more than 50% of the capital at any point of time. Why? Because whenever the market turns, whenever the market starts going up, I've experienced, you will get these kind of trades with many stocks. So many amateurs or beginners, they will take many trades at a time on one day. For example, they take 5 trades, 6 trades, 7 trades like this. So if you do this, for example, if the market just turns from that moment, you will face losses for most of those trades. So that's why I always suggest uh, you know deploying only 50% of the capital at any point of time. Suppose if you have 10 lakh rupees as your trading capital, so at any point of time you should deploy only 5 lakh rupees. 5 lakh rupees, remaining 5 lakh rupees, it should be in your account. Either you can keep it in liquid base or some other ETFs, that's a different story. But you should invest or you should deploy only 50% of the capital at any point of time. So this is one more important rule. And again, the third rule is interconnected to the second rule. Don't take more than 2 trades at a time. Why? Because whenever the market turns, the general market turns, you will get many number of trades with many stocks. Similar hidden divergences you will get with many stocks. So whenever you face such a situation, for example, you see five stocks, they are showing RSI hidden bullish divergences. So in that case, don't take trade in all the 5 stocks. You can pick one or two. Two is the maximum. So on any trading day, based on this RSI hidden bullish divergence, you should take only maximum 2 trades. Okay, don't take more than 2 number of trades. If you follow these all these rules, there is a high possibility of getting success in this particular strategy. So I'll repeat, friends, strategy is very, very important. There is no doubt, but risk management is also, money management is also very, very important. And your trading psychology, facing losses or profit with the same calm mindset is very important. And the fourth one is successful execution. So these four concepts are four legs of a table, where the table stands for a successful trading. So don't forget any of these things, and all these things will help you to make money, make profits in the long run. I hope this video is added value to your time, friends. If yes, you can share and you can like the content, you can subscribe to my channel, and you can also share this video with your friends. I will see you in the next video with another useful content. Thank you. See you. Bye bye.